Welcome to The Explainer. Today, we're unpacking a really fascinating initiating coverage report from Systematics Group on Dhanuka Agritech. We're going to look closely at the numbers, the strategy, and the temporary headwinds that seem to have, completely clouded the market's judgment on this one, to understand exactly why this agricultural stock might be significantly undervalued right now. So let's just jump right into the core mystery here. How does a company with a pristine, debt-free balance sheet and a really high return on equity end up getting punished by the market? In the Indian agrochemical space, where heavy borrowing to finance distributors is pretty much the norm, having a net cash position is incredibly rare. Yet here we have a branded crop protection specialist with a pan-Indian network reaching over 10 million farmers, and it's trading like it's a distressed asset. The analysts at Systematics Group actually see a massive 31% upside here. They're giving Dhanuka a target price of 1,350 rupees compared to its recent levels around 1,023. They've initiated coverage with a very solid buy rating, basically driven by the belief that the market is just severely underestimating the company's impending earnings recovery. All right, here is our roadmap for today. We'll cover 1. A steep valuation discount. 2. The FY26 perfect storm. 3. 5 engines firing up. 4. Solid financials and peers. And 5. Risks and final thoughts.
Starting off with Section 1, a steep valuation discount, the market disconnect.
What's truly staggering to me is this number. The stock has seen a 39% drawdown from its 52-week high of 1,665 rupees, dropping all the way down to that 1,023 mark. The market has priced in just a tremendous amount of pessimism here. It's essentially treating temporary cyclical headwinds as if they're a permanent structural impairment to the business model, which is a classic setup for a value play.
Moving right along to Section 2, the FY26 perfect storm, a temporary washout.
Okay, what actually caused this dramatic reaction over the last fiscal year? Well, FY26 was hit by this absolute perfect storm of weather, regulation, and expansion costs. First, we had unusually uneven and excessive rainfall, and that totally disrupted the application window for herbicides, which, by the way, is their fastest-growing segment. Second, a sudden regulatory transition hit their high-margin biostimulant sales. That dropped revenue in that specific segment from roughly 1.1 billion rupees down to 0.7 billion. And finally, their brand new Dahej chemical synthesis plant was in its initial phase, so it was operating at an EBITDA loss, creating a temporary drag on overall profitability. But again, none of this is permanent. That brings us to Section 3, 5 engines firing up, the turnaround catalysts. Let's look forward, because this builds into the analyst thesis of 5 distinct engines that are going to drive a massive recovery in FY27 and FY28. They aren't just sitting around waiting for better rain, right? From simple weather normalization and recovering biostimulant sales, to strategic global expansions and launching products for high-value horticulture crops, Dhanuka is pulling multiple levers all at once to get growth back on track. Let's zero in on that Dahej plant for a second. This facility is actively transitioning from a cost center to a profit driver. Management expects it to hit about 80% capacity utilization soon, which means it swings completely from an operating loss to a positive contributor. And actually, they are already planning a second multi-product plant and are in active talks with Japanese and European companies for manufacturing partnerships at this very site. It's a huge shift. Then there's the Bayer transaction, which is just a brilliant move. Dhanuka acquired these 2 franchises from Bayer. In FY26, this was just acting as transitional royalty income. But from FY27 onward, Dhanuka takes full commercial control. They shift from passively collecting royalties to actively domestic manufacturing and exporting these lucrative molecules globally. They are unlocking a massive, multi-year compounding revenue stream that, frankly, the current stock price is completely ignoring. Now, Section 4, solid financials and peers, the hard numbers. Let's look at the actual data. If you want to see the undervaluation argument clearly, look no further than this comparison. Dhanuka is trading at roughly a 14x forward PE. Now look at PI Industries and Sumitomo. They're up at 28 to 32 times. Yes, those peers have export and MNC premiums for sure, but Dhanuka is literally debt-free and puts up a return on equity of 18 to 20%. To trade at half the multiple of your peers despite matching their financial quality, that's a staggering valuation gap. And when you factor in those 5 growth engines we talked about, analysts are projecting a really robust revenue recovery over the next 2 years. You can see the jump here from a flat FY26 straight back into double-digit growth, aiming for over 25 billion rupees by FY28. And the thing is, this doesn't require a miracle. It's mostly just driven by a return to normal weather, getting those biostimulant sales back, and targeting high-value crops like grapes and tomatoes.
On the profitability side, overall annual margins are expected to stabilize near 19.7%. But here is a little hidden gem. They actually exited the fourth quarter of FY26 with a massive 25.8% margin. That hints at some very strong operational momentum. The drags from the Dahej ramp-up and lost sales are reversing, which puts a really solid floor under these margins going forward.
Plus, we have to talk about their working capital, which is basically acting like a coiled spring right now. Because of the weak season in FY26, inventory levels rose by about 30%. But as demand normalizes, those inventory days are going to compress, and that is expected to release over 200 million rupees in cash in FY27. It just further fortifies an already incredible balance sheet. And if you need a signal of internal confidence, how about a promoter-backed buyback at a 38% premium to the current market price? Think about that. The board is willing to buy back shares at 1,400 rupees when the market is pricing them near 1,000. That's a massive behavioral anchor. It's management putting their money where their mouth is, signaling they think the market has got this entirely wrong. Which brings us to our final section, Section 5, Risks and Final Thoughts, the verdict. Because we always have to look at what could go wrong. The biggest hurdle, undeniably, remains the weather. The IMD projected the southwest monsoon at 90% of its historical average. So if the rains fail again, that elevated inventory we just talked about, it becomes a real burden. Plus, there are legitimate execution risks in ramping up the Dahej plant to 80% utilization in a weak demand environment. And any delays in getting international regulatory approvals for those Bayer exports could definitely push the earnings recovery further out. So it all boils down to this. Is the market missing the forest for the trees by obsessing over one bad rainy season? With a rock-solid net cash balance sheet, heavy insider confidence via that buyback, and a clear structural pivot toward global manufacturing, Dhanuka Agritech is just a fascinating case study in market psychology versus actual business fundamentals. That wraps up our explainer on the systematics report. Keep questioning the consensus, and I'll see you in the next one.